Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Jose Minaya of BNY Investments and Wealth writing this: volatility is here to stay invested and look for the right diversification. Jose joins us now for more. Jose, good morning.
Hey, good morning.
Just want to pick up on that first line. Volatility is here to stay. Why is that?
Look, I think volatility, clearly we're at an all-time high or peak in terms of the noise in the markets. If you just think about back to the beginning of the year, our team kind of added around 26, 27 different policy changes or news cycles that really kind of impacted or jolted the markets. Yet the markets have kind of powered through that, right? I think I was on one of your shows earlier in the year saying around, hey, you should not be risk off. And this was like right after Liberation Day because of like what we're seeing in the fundamentals and trying to look past this noise. Seeing a White House and administration, there's a little bit around the carrot and the stick, right? We saw a lot of the stick at the beginning of the year. Now you're seeing more of the carrot. And again, the markets are responding to that. So it's less about today when we talk to our clients around, hey, what should you be invested in or not? But it's more about what are the solutions you're looking for. You're seeing more and more of that in the industry, whether it's technology with kind of SMA capabilities, what you're doing with model portfolios, which we do in BNY Advisors. Across the board, it is about staying invested through these times, but kind of understanding what outcomes you're looking to get.
Well, let's run with that. Stay invested, long-term time horizon. Got it. What are these strategic anchors you're offering people to get them comfortable with doing just that?
Well, I think, again, it depends on their needs and outcomes. In some cases, it might be, hey, they're looking for income, right? Like we create a lot of like what we call like, bond portfolio in a box or personal bond portfolios with our Insight investment platform, where it's like we're getting very customized in how we deal with our clients. It might depend on when are you looking to retire? Is there a wedding? Is there educational needs and these things? So you might need principal protection. I've got a new niece on the way. In that case, I'd be like, hey, you should just go long equities. So again, we could spend a lot of time thinking about the noise, the volatilities out there. If you look at, it hasn't paid off to just say, I'm going to stay off the markets. And there's still a lot of cash out there. But again, that idea of I'm going to stay invested, but am I really focused on my solutions and my outcomes versus call it a 60-40 type of portfolio?
Congratulations on your incoming niece and going all equities in response. I am curious,
for her. Yeah.
For the niece, not necessarily the parents, but I am curious about how much going forward the ballast for income comes from the same place. You said not necessarily a 60-40 portfolio. Let's say someone is conservative and looking for income. Does it still come from U.S. Treasuries? Does it still come from credit? Or do you have to look elsewhere for that type of ballast?
No, I think the markets are becoming a lot more efficient and they are looking elsewhere across the board. Again, we've seen the advent of private credit. It kind of plays a big part of this. You saw with the Secure Income Act where now annuities and guaranteed income contracts are being allowed to be used in 401k portfolios. I think these are all important legislations that are all kind of recognizing the incredible crisis we have from a retirement perspective, not just globally, but definitely in this country. So you need to kind of look more broadly.
There's a little bit of skepticism in younger generations, it seems. There's this concern that maybe the same kind of gains that the older generation saw in their portfolios are not going to subsist in their generation. Do you think that it will? Do you think that the returns will be the same in the next 10 years that it has been for the past 30 years for a generation that has gotten wealthy off stock market returns?
I don't. And what I mean by that is if you look back over the last 20 years, you would have been, for all this discussion around different investments, hedge funds, private equity, at the end of the day, you would have been just fine doing a very low fee, kind of like passive equity fund, and you would have been just fine. I don't think that's the case in the next 10 to 20 years. It's just a lot more volatility. There's a lot more volatility out there. I think returns are going to be more measured, yet it's, again, finding your spots. Again, it's not about anymore, can I find the strategy that just I can sit back and it's just going to grow 15, 20%. It's being able to do the work around how you diversify your portfolio.
I applaud the risk appetite of the younger generation, looking at things like crypto. Don't you?
Where else do you
Their
get
risk
the gains?
appetite is far higher than it was when we were growing up.
But maybe not necessarily for the same instruments. And this is exactly where I was going to go. It's for Bitcoin. It's for hedge funds. It's for NFTs. It's not necessarily for some of these other instruments. And are they correct?
Yeah, I would actually, slightly disagree, John, a little bit, that I think if you look at the younger generation, they tend to be a lot more risk averse in terms of buying a home. They're buying their first home.
Well, that's an affordability issue.
Affordability.
They just can't afford it.
Yeah, but I have conversations with some of these folks, including in my family, where they're heavy in cash. But if you look at their portfolio, what they're invested in, they are invested in crypto or these things. So there's a lean here to technology and some of these quote unquote cool things versus, look, just put your money in a 401k and max it out. Hey, by the way, do a balanced portfolio, set it and forget it. That stuff, I think there's a lot more risk aversion.
Can we get your ideas on what to do with bonds? This is what Michael Harder of Bank of America had to say this morning. Best performer decade to date, gold. Worst, Treasuries. Calls it a decade of inflation. What should you do for the decade ahead, and what do you do with that bond portfolio? You talked about income. A lot of people are very worried about inflation hanging around for too long.
Yeah, look, I think we've got a more kind of constructive view on inflation. It's why we still see the markets kind of maybe topping out, or the wide end for us is around 6,400 S&P. But look, I think this is a time where there's likely to be more rate cuts coming, right? You can debate whether that matters or not. You were just having that conversation. I think it's a good time to lock in yields today. And again, for us, it's not necessarily just about what's going on with treasuries, right? It's again, how are you looking at your overall platform and portfolio? There's a lot of different kind of characteristics to take into account.
Jose, I appreciate your time.
Thank you.
Thanks for giving it to us. Thank you. Jose Minaya there of BNY. Here's the take from Jeannette Lowe of Strategas, a bad company. Even if some of the tariff levels issued in Trump letters are designed to accelerate negotiations with some countries, not all countries will reach deals. Tariffs are going higher from here. Jeannette joins us now for more. Jeannette, welcome. I just want to build on Lisa's point. Do you think this record high in the equity market is a green light to keep pushing?
I think the important thing is that if you look back at what happened on Liberation Day, Trump put very aggressive tariffs on the table. We saw a sharp stock market reaction. And then you had the threats of there could be, shortages on the shelves and things of that nature, which then started to make the president walk that back. Now we have more fiscal policy. We have the tax bill, the One Big Beautiful Bill Act that has been enacted that provides some fiscal policy cushion, provides some relief to consumers and businesses with regard to the tariffs. And now we have a stronger stock market at this point. So the market isn't looking like it's as negatively impacted. So that does embolden the president to go forward and be more aggressive now. We're also not seeing inflation show up yet. But at some point, there may be start to see some increases in inflation in the CPI data or even in company profits. And that's something else that we're watching quite closely, is to see if there starts to be more economic pain that might show up. It might not be until closer to that August 1st deadline, but that then may make the administration try to rethink how these things get calibrated.
Jeannette, I want to pick up on something John was asking earlier. How much opposition is there to some of these policies from the Democratic Party, given the fact that, it's kind of a grand experiment. And if the economy doesn't roll over and the income from tariffs really offsets the deficit, who's going to really lobby against these?
Right. So I think one of the things that's going to be important is at some point, we do have inventories that were pulled forward ahead of some of these tariffs. The longer they're in, that's going to change the makeup of this picture. So the Democrats have an issue where, they've wanted to put into effect more restrictions on trade in some ways to help trade unions in the United States. Maybe not obviously to the extent that Trump is doing, but it does bring up the question of how do you then roll these back? I think there is definitely a difference when you saw the Biden administration able to keep the tariffs on China in place that Trump imposed, but that's much different than putting in, say, 20% tariffs on EU goods or 35% tariffs on Canadian goods. So there can start to be that pushback there. And you did see, obviously, earlier this year, Tim Kaine, senator from Virginia, put forward legislation to kind of walk these back. That did not pass, but that is something that they're probably going to push again. And if we do see more economic slowdown because of the tariffs, that could be something that then gets more traction later on.
We initially thought coming into this year that this would mostly be about China and the rest of the negotiations would be fairly easy. That, of course, has been significantly challenged, and now we have the potential for some sort of additional meeting between Chinese and U.S. delegates in the next couple of days, at the same time that the tariff rate on Canada seems to be similar to the one on China. How do you make sense of this? What's the ultimate goal when it comes to China?
Well, I think we do still have to keep a difference between what is happening with China and what is happening with the rest of the world. One of the things, obviously, Trump did say that the Canadian tariffs were based on fentanyl, but also other things, other market access issues, mentioned dairy in the letter. We have actually seen more fentanyl coming across the border if you look at the most recent customs data. So that could have been an impetus for this. The digital services tax was also an irk for the Trump administration that they wanted to get taken away. But I think that they're ultimately, if we still have this carve out for goods that are USMCA compliant, that is significant. I think there's going to probably be a push to get more goods to fit that USMCA compliance setting so that they would be able to enter the U.S. tariff free. But there's definitely still a difference with China. If you look at China, we still have tariffs from Trump's first term. Those were never removed. Those were kept in place by Biden. They were actually increased. Trump has now increased them even further. And if you look at a lot of the trade deals or the discussions that have been occurring with the administration and other countries, it's also about country of origin. Is China putting goods into Vietnam that then get shipped to the United States? That is something that the White House would like to stop. So we still think that there is a much more aggressive tone towards trade with China and trying to get production out of China and into other countries or back to the United States. And that is still going to be a difference going forward, regardless of the talks that may happen.
Jeannette Lowe of Strategas, a bad company. Jeannette, thank you. Build on some of these conversations. Angelo Zino of CFRA joins us now for more. Angelo, I want to start with Nvidia. A theme of your research over the past few months is that Nvidia has de-risked the China story. Could you just explain to all of us how they've gone about doing just that?
Yeah, no, thanks, John. So, for the most part, you kind of look at just their most recent results, and they've essentially come out and zeroed out the potential for China when they've actually also said that there was an $8 billion opportunity in the quarter that they're missing out on because of China. So we know there's a massive opportunity and a growing opportunity out in China, but in the same respect, we know they've de-risked it because they've essentially zeroed it out. And we'd expect China at this point to represent less than 5% of sales from the company, essentially all of it coming from gaming and what have you. So that's what we mean by it being de-risked. I'd also say this, when we saw the reversal of the EDA software restrictions kind of lifted last week, I think that is also kind of increasing the sentiment out there or belief that potentially Nvidia does have that opportunity to get back into China. You just kind of heard Ed talk about that opportunity as well in terms of a new potential chip out there. So I think when you kind of look at the dynamics right now, it's tilting more favorably towards Nvidia potentially getting back in there, with the respect that right now there's nothing coming from that region as well.
Angelo, there's sort of this deeper psychological question, and it's been underpinned by what Ed was outlining from Jensen Huang, what he was saying over the weekend, that ultimately if the U.S. wants to be dominant in this sphere, which is like being the reserve currency, that it needs to allow a greater degree of sales into China. Do we have any sense of how much that message is resonating in the White House?
I think it has to be resonating to some extent because, it seems like, at least right now, the Jensen's got Trump's ears in some respect. They're having face-to-face meetings. I think that's definitely a good thing, more so than I think, some of these other tech leaders are having. So, I think it's resonating to an extent. I think Trump, it definitely respects Jensen. And at the end of the day, just looking at some of the recent moves that we've seen, again, with that software ban and just potentially using Nvidia's chip as a bargaining chip, their business as a bargaining chip, like we saw with Saudi Arabia, I think just it points to the fact that, hey, listen, it is resonating that, they're not necessarily looking to block Nvidia out across the globe, but they do want to leverage Nvidia with these trade deals out there. So I think it's more along the lines of investors at this point being patient, but I do think ultimately you do see Nvidia again back into China as well as other regions of the globe.
I wonder how much it's important for analysts like yourself to see Jensen Huang with the ear of the president. And who doesn't have the ear of the president? And I'm thinking of Tim Cook of Apple, who seems to be falling off the bandwagon when it comes to his favorability in the president's eyes. How much do you agree with Walter Piecyk of Lightshed, as John was talking about, this idea that this is somebody who no longer really has the creative or even diplomatic helm of Apple in a way that benefits the company?
Yeah, I mean, listen, we are a little bit worried about Apple in the sense that, historically they've been very slow to move to changes, right? I mean, and it's worked in the past in the sense of, hey, listen, we want to make sure we get this right. And we're not going to be, quick to move, and we don't necessarily need to be the first ones out there. However, in an AI-driven environment, things move really, really fast. And in that type of environment, I do think Apple needs to change to an extent. Now, it doesn't necessarily mean that they have to, get rid of Tim Cook. I'd probably say that's something you don't want to do at this point in time. And the reason for that is because we are seeing a number of departures at the company. At the very least right now, I think you need to hold on. You want to hold on to Tim Cook and have that solidified, at least at the CEO level. So, but I do think changes need to be made. I do think the company needs to work faster. Again, does it need to be done via some M&A, just acquiring more talent the way Meta has? I think all those should be on the table at this point in time. But the most important thing right now, I think, is really kind of getting the Siri integration across the App Store right. And they need to get that done here within the next 9 to 12 months to at least restore some credibility within the company and with some of their developers.
Do you think that's achievable with the tools and the talent they have in-house right now, Angelo? I think that's the ultimate question.
To be honest with you, I don't know. The answer probably is probably no. And I think the reason I say that right now is because they are looking elsewhere in terms of, the perplexities of the world and what have you to at least fill a void, or even, via Anthropic or an OpenAI. So I think Apple realizes they are behind, but it's actually a good thing that at least they've realized that and they're trying to do something about it. And as long as they can fill that void, whether it be temporary or what have you, that's extremely important, I think, for investors at this point in time.
Angelo, I appreciate your time. As always, thank you, sir. Angelo Zino there of CFRA. Steve Ricchiuto of Mizuho writes in the following: the lack of systemic risk in the economy should ensure the economy will remain as impervious to shock. Steve joins us now for more. Steve, good morning. It's good to see you. Okay. Let's talk about that. The shockproof economy. We've been teasing it all morning ahead of your appearance. What is so shockproof about this economy? What makes it shockproof?
Well, as I indicated, there's no systemic risk. There's no asset liability mismatches, and there's no asset price bubbles. So typically systemic risk occurs when there's an asset price bubble that is funded by an asset liability mismatch, i.e. you've borrowed short and invested long. And the rising asset price bubble, eventually a curve inversion changes the economics, the bubble bursts, capital's destroyed. And when capital's destroyed, liquidity just sucks out of the economy. In an environment where assets and liabilities are matched and there's no asset price bubble, a curve inversion had no impact. And the economy, because balance sheets, when you go down the chain through non-financial corporates, households, banks, shadow banks, because the balance sheets are strong, everyone's deleveraging, everyone has very, very exceptionally low debt servicing costs and relatively long duration. You're in an environment where nobody has rollover risk, nobody feels the impact of anything that happens from the interest rate environment, and therefore you don't have the same kind of credit-related issues that have typically popped up and caused a problem.
Is this a shockproof economy or a shockproof market?
Oh, no, it's a shockproof economy because corporations are in this position as well. Non-financial corporations' debt service burdens go back to 1960 levels. And they've been deleveraging since the financial crisis. Even though we have record corporate issuance, the amount of corporate debt outstanding is actually continuing to go down because we refinance less than we're actually maturing off. Corporations in this country are cash rich. And we see that in terms of their cash positions, whether it's the Mag 7 or even when you go down the chain of to smaller and smaller companies, you see this buildup of cash that has taken place. It's one of the reasons why there's an excess supply of savings in the economy that's helping to dampen long-term interest rates.
Okay, so this is a reason why the economy hasn't tanked and why you haven't seen any kind of real deterioration in equity valuations. But can you see ongoing strength in the face of potential, I don't want to say shock, but changes, real changes to trade and potential tariffs that could be much higher than people are currently expecting?
Again, because of the ability for companies in this very solid financial position to adjust their businesses, which gets back to your Tom Keene quote, you wind up in an environment where basically you have the ability to adjust quicker than people think. And this is really what sets the U.S. economy largely apart, because we are the largest, most leveraged nation in the world. So you have to understand credit to understand how the economy functions. And in an environment where credit quality is excellent, you see that in spreads, you're seeing an environment in which there's really no issue. People can get the funding they need to morph their businesses, or they just use it out of internal earnings.
One additional task now for economists is to navigate policy coming from this White House and really understand what the strategy is, if there is one. You've pushed back against the people that have suggested there isn't one. You believe there is. Yeah. So let's get into that. What is the strategy?
Well, I think you have to understand the strategy is on three-dimensional. There's geopolitical, there's socioeconomic, and macroeconomic. And we in our business tend to just think in the macroeconomic plane. But you look at things like what Trump is doing, like what he just did with Brazil, what he's doing with China. Those are geopolitical issues. Then you look at Mexico, and it's largely a socioeconomic issue. So you've got to take apart some of these things that seem irrational from a macroeconomic standpoint, and then look at the macroeconomic piece of it and saying, well, what he's doing so far is basically attempting to create a level playing field, which corporate America kind of likes, number one. Number two, he really keeps on, as we indicated with Mike McKee, keeps on pushing out the dates of these tariffs, and people are beginning to recognize it is a negotiating trick on his side. So you begin to back away from the paranoia that comes out of it, and you have to ask yourself a question. Does Donald Trump really want to destroy the economy going into the midterm elections? The answer is no. I think Donald Trump wants to try to expand his polarity in the midterm elections to do what he really wants to do, which is drain the swamp, which means he needs a bigger majority in Congress to change some of the laws that have been keeping us with a structural deficit of $2 trillion.
Is that a recipe that comes with higher yields or lower yields, higher rates or lower rates?
I think the risk is it comes with higher inflation and with it higher yields. I think the presumption that the market has had continuously that the Fed needs to cut interest rates because the economy is somehow or another weakening. This economy is capable of running a trend. And when you throw fiscal stimulus on it, you will get above trend. And even though you could say over the long term, the Trump tax cut and the tariffs may net out, in the 2025-2026 period in particular, the tax cut is front-loaded. So you wind up with the net stimulus helping to lift the economy in 2026.
Given that, if the Federal Reserve does cut rates this year, will that lead to hotter than expected inflation in the medium term that challenges that?
I think it'll lead to a backup in yields almost every bit as much as they cut short-term interest rates, as we saw happen last year. I think when you cut interest rates when you don't need to cut interest rates, it's not a good policy prescription. And they clearly made a mistake last year, and I think they're sitting here this year with, as Mike indicated, you've all indicated, that you have situations in terms of the potential of tariffs coming down the pipeline to lift prices, and you have an economy that's proving to be very, very resilient. You've got a labor market that's proving to be very resilient. What would be the benefit of cutting interest rates?
Steve, you've called the economy really well so far. Credit to you. It's good to catch up. Thank you. Thank you very much. Steve Ricchiuto there of Mizuho.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.